All right. So this is the debate that we've been having for quite a while now. And I am on the side of Tesla buying back shares, or at least, starting with an authorization of a share buyback, which is typically how it goes. How this entire program works is that the board has to first authorize a buyback and set aside a certain amount of money for doing that, and then management goes ahead and executes that buyback according to their discretion. And so that's basically my personal position on this, is that I think Tesla has now reached a point where the balance sheet is so strong that it's completely de-risked from what companies typically do to prepare for things like recession or economic uncertainty and things like that. And I have data, that kind of points that out. But just as just sort of an opening remark, that I think they've gotten to that point where the balance sheet is so flushed with cash, and at the same time, Elon Musk and company are allocating capital as fast as they possibly can into growth, into factories, into superchargers, into 4680, into R&D for software. It's going as fast as it possibly can, and yet the company is still generating positive free cash flow, which means that, to me, this company, Tesla is going to continue to swell the cash position on the balance sheet beyond the point where other companies let it get to before doing things like stock buybacks and dividends. So that's my personal take. And Alexandra, you can go ahead and make your opening remark.
Just wanted to point out, I prepared this meeting with some charts and with my notes, and I just posted those on X. So if somebody, wants to follow my reasoning in writing and see those charts, that's an easy way to do it. There's also a link to the Google Doc where I summed it all up. It's only my notes. It's just, I've done this morning quickly. It's nothing major. Oh, wait, now you're inviting me as a co-host. I will do that, but once I'm done speaking, because it will break up in the middle. So my main point is that I think share buybacks is what I call shtish. I didn't say shit, shtish. What does that mean? It's a seasonal, short-term investor sugar high. I mean, Gary will know about sugar high because he always tells us that there are so many other sugar highs. Why does it come up every year again and again, and always between Q2 and Q3? That's a very good question I would like you all to ask. But the thing is that while a year ago I could see a path to it and actually wrote some substacks on it and recommended treasury buybacks rather than just pure share buybacks where you retire the stock, the situation is completely different. And for those that have the chart with the yellow and blue and green chart there, you can see in blue the free cash flow position of Tesla. While Tesla is still financially very strong, the free cash flow position has completely changed due to a number of reasons that we can all debate here. But if it wasn't done a year ago, and it wasn't done a year ago not because Elon didn't want it. Elon actually twice said, both in the shareholder meeting and in the Q3 earnings call, that he's not opposed to it, but it's up to the board to decide. So obviously the board didn't green light it, which also shows to me that the board is not just people that kiss up to Elon, but that they have their stance. And actually those that read the book know very well that's the case. So anyway, so the board didn't approve it in Q3 2022. The situation is by far not as easy now. So I'm not even talking stock price and all the rest, but if it wasn't approved last year, there's certainly no basis to approve it this year. So that's my main point. I've got a lot of other points, but I think that's the one we should start with.
Sure. Does anyone else have another comment or?
Sure, I'd like to. I can. So look, from my standpoint, it's not about, there's a lot of erroneous information out there. People say, well, if you do buybacks, you can't build factories or bots or anything. And, people who, do finance for a living know that buybacks are after all capital spending, all organic growth initiatives. And so when you have free cash flow left over after capital spending, those buybacks compete with dividends, they compete with debt retirement, they compete with M&A, and they compete with cash buildup. And unfortunately, what Tesla's been doing with its free cash flow after all those organic growth initiatives is letting cash build up at 4 to 5%. And that's pre-tax. So after tax, maybe they earn 3%. to Alexandra's point, if Tesla had bought back stock, back when we were thinking about it, which was, between 110 and 100, it would have had a much higher, what we call an internal rate of return. You calculate the internal rate of returns like ROI, where you look at the current stock price and you go out 3 or 5 or 10 years, how many years you want to go out, figure out where's the stock going to be back then, and then you put it into a spreadsheet or you put it into your HP12C, you can figure out what the IRR is. At today's $260 price, the IRR is about 12.5%, assuming my low target price. So that's still a lot better than 4% cash. And I'm not saying use all the cash. I'm just saying if we have 23 billion of cash today and the free cash flow, our forecast is 50 billion over the next 5 years, buy back, say 10 billion of it just to have it out there so that when the stock gets hammered, because the market sometimes gets it wrong, buy it back, you're getting a 12, 13% IRR, and it will allow institutions to be much more willing to say, okay, there's good capital deployment here at Tesla, whereas today a lot of institutions say they're just going to put it into cash. I could put my own money into cash. So that's what keeps a lot of institutions out of the stock, among other things, but that's one reason I've heard from people. So my view is that let's clear the misconception that if you buy back stock, you can't build factories or bots. That just makes no sense, because by definition, or after all organic growth initiatives, they compete with cash building up at 4 to 5%. And the question really comes down is, would you rather Tesla build up cash at 4 to 5%, or would you rather them buy back stock, a limited amount of the free cash flow to go into stock buybacks instead of building up cash?
I'll let you go first, but I'll address all that after.
Well, I'm going to address some of it myself as well, but of course I'd love to hear your views as well. Can you guys hear me well? Is that okay?
Perfectly.
Great. So Gary's absolutely correct, and Alexandra is absolutely correct. I think while Gary is correct, I think he omits one very essential component, as Mayor does as well, of why companies amass liquidity resources over and above the CapEx plans and operating capital requirements of a company. Believe me, I know. I've run many a company, and not just an investment company. I've run companies that have depended very heavily upon their CapEx and their innovation. But companies amass cash for strategic reasons. Those reasons include economic difficulties, the current economic environment, and the potential economic environment. They also include strategic needs in terms of future acquisitions or future investments or future developments. So it is very difficult for us sitting here looking at Tesla externally to say what Tesla's plans may be. We know what their CapEx plans are. We don't know what their strategic plans are, and we don't have an insight into their understandings of the strategic environment of the personal transportation market. We do know that there's going to be some massive changes in that market, changes that are structural, changes that could imply an enormous capital investment requirement. And we also know that those changes may be coming with a backdrop of severe economic, let's just say, discombobulation. It's very difficult to determine, it's difficult to foresee what those economic circumstances are going to be. It's difficult for us to determine what the economic circumstances of next month will be. We've never been in a period of such enormous economic change as we're facing in the next decade. We do know that the United States has an enormous budget deficit, larger than any since, in fact, it's now beginning to exceed that of the Second World War. We do know that China faces a tremendous economic challenge in its structure, in its structural economic environment, with the demise of the property situation in China. We also know that the world is facing, two major wars simultaneously with an alignment of East and West, which, recalls the worst times of the Cold War. So we're in times of economic uncertainty, the likes of which I have certainly not experienced in my lifetime, and I'm probably older than most of us on this call, but one which I think is a very dangerous one. Others have a more sanguine view of it, but I don't think Elon has. And I think that the company, taking all these things into account, is doing exactly the right thing. It's doing the thing I would do. I have a fair record of success in my business career. I think this is a business decision. This is not a financial analysis decision. That's my view.
I completely agree, Mary. If I may, Mary, I just want to add 2-3 things to this one. If we only look at it from a projected capex expenditure, and I've seen your graphs, they were very good. That's not the point. The point is there is clearly margin pressure, as Gary knows, and Gary has sold some Tesla in the last 24 hours, so he knows very well about the margin pressure. So where does this margin pressure come from? The macro environment, Larry explained very well, but then you also have to look really at the specific market in which Tesla operates. So we have this high interest environment, which makes cars less affordable, and you have to adjust by giving up some of the margin to make it affordable. You have the ramping of the Model 3 Plus. We have the Model Y refresh that probably will go worldwide. We have obviously the ramping of the Cybertruck. Those are all periods, as Jeff explained very well in his video on Monday. Those are all periods where margin is going to be eaten up just by these ramp periods. We had Drew explain that in the last 2 earnings calls as well. And at the same time, and I'm always insisting on those charts, you have the Chinese car makers heavily subsidized. I mean, there are 10,000 reasons for it, but now competing worldwide except for the United States. So Tesla is running against the Chinese car makers, and they may not be the same quality and they may not be exactly how we wish they are, but there are the choices the consumer has these days at much lower prices. And I had published some of those prices at which they go into these local markets, notably to Vietnam, at 85% lower than the Vietnamese cars that they found there. So with that environment, the margin pressure on Tesla will persist for a couple of quarters to go. I mean, like Larry, I don't have a crystal ball knowing how long this will last, and maybe it's getting much easier. This is the most difficult economic times to read and has been for the last 4 quarters, and is still not getting better. So I really don't want a company that is sitting on a considerable amount of cash, no doubt about it, now play with sharebacks. And just one logical reason also for sharebacks. So the shares outstanding of Tesla today are 3.171 billion shares, okay? Exactly a year ago, it was 3.15. In December, it moved up to 3.16. So why is that? Because there's employee shares issued. So they're issuing about 10 million shares per year for their employees. Doing a 10 billion share buyback costs or pulls out of the market 3.8 million shares. 10 million employee shares issued per year, 3.8 million the share buyback. So I see that it would be a fancy announcement, but in terms of earnings per share, in terms of really changing the perception of the stock, it will do nothing, yet it will take 10 billion of free cash away. So I'm really completely against it. But Mayor, up to you now. Sorry, I missed this.
No, I think all we have to do is ask a couple of fundamental, super simple questions. Do you believe that Tesla stock is going to outperform, let's say, T-bills over the next 5 years? I mean, you guys both laid out all of the risks that Tesla is going to deal with over the next, year or 2 years maybe. But ultimately, you guys are Tesla bulls at the end of the day, right? You still believe that Tesla stock is going to outperform over the next 5, 6, 7 years. If that's the case, then a buyback makes sense as long as the company is producing positive free cash flow. So even with this margin pressure that we've seen over the last year, Tesla generates $6 billion of free cash flow over the past 12 months, 4 quarters. That's a doubling from 2021 and almost 2.5 times that of 2020. So,
most of that Q4, not this year.
Sure, but now we see sequential improvement, right? From Q1 to Q2 and now from Q2 to Q3, most likely, I think we're going to see another sequential improvement in free cash flow because we just got the production deliveries report, which showed, there were more deliveries than cars produced for the first time in a while. That should be positive for free cash flow. We'll see what happens, but I think it's going to be another big sequential improvement. So this is a lot of cash that's being generated despite max, pace of investment. So I think I speak for myself, but I'm pretty sure Gary would agree too that nobody in the pro buyback community wants Tesla to cut back on factories. Tesla generates 25% ROIC on their capex. If you use the traditional return on invested capital definition, it's a very profitable business. So there's no reason to do buybacks at the expense of investing in themselves. So nobody's advocating for that. But what we want to do is to take a portion of their free cash flow and use that for a buyback. So, and we're also not saying to wreck the balance sheet either. I don't want to take, $20 billion and throw it all into Tesla stock today, right? I don't think anybody's saying that either. Typically how buybacks happen is that management uses discretion. Once the board makes the authorization, even if it's a big number like 5 billion or 10 billion, that doesn't mean that the CFO allocates all of it all at once. It's usually broken up over a decade. And the reason why we advocate for this is because studies show, there's numerous academic studies that show that companies that buy back shares outperform companies that don't in the long run. So this is a program that benefits long-term investors. People keep saying that a buyback is a short-term high or sugar rush. No, it's not. Because I can almost guarantee you that if Tesla announces a buyback tomorrow, the stock is going to be up nominally. Maybe it has a little bounce. It's not going to outperform because this is not something that benefits traders. Buybacks benefit long-term investors, those that buy and hold for years. So that's what this is for. So as long as Tesla's max investing in capex, R&D, working capital, M&A, right? And we've seen that Elon kind of doesn't like acquisitions unless if they're very small. It doesn't seem like he really likes the big acquisition. He's not that type of a person. He likes to build everything internally. So don't envision Tesla going into a big acquisition. Maybe I'm wrong on that. If it is, that'd be great too. I'd back off of this buyback talk, ASAP. If Tesla says, hey, we want to buy, Albemarle, we think that'll secure our, future with, huge supply of lithium, I'd be like, so be it. And I'd drop this buyback talk. But in the absence of all that, when Tesla's investing at a furious pace, by the way, if you've read the 10K, they're only guiding for $7 to $9 billion of capex per year for the next 2 years. So, we can talk about how expensive all this is going to be, but at the end of the day, they've done the numbers and they're telling you that they're only going to need 7 to 9 billion per year. Over the past 4 quarters, Tesla's done 14 billion in operating free cash flow. So even if they don't grow at all, if they have 0%, growth of operating cash flow for the next 2 years, they'll still be positive free cash flow. So this is, again, it's very profitable.
Mayor, I want to put two numbers in question. So you said the free cash flow is 50 billion. It's not. It's 22, and the rest is accounts receivables, but on the other side, there are accounts payable. So I think we should stick with the 22 number. The second is, in the last 2 quarters, we had 2.5, if I remember right, 2.5 billion of operating cash flow, and then 3 in Q2. But in free cash flow, it was nearly 0 in Q1, and it was hardly 1 billion in Q2. So giving away 10 billion in a program, and even if it melts down over time on a share buyback, is not the right relationship. We're not Apple in 2013, 14, 15, not yet. This will come, and this will come when income comes from different streams. But at the moment where income is still mainly coming from car sales, not yet enough from energy, and certainly not enough from software as a service, I think this is actually risky. This is not the right moment to do it while we're not diversified enough.
Right, but free cash flow is at the end. That's the bottom line number, though. This is not, we're not taking away from any of their businesses. Free cash flow is the bottom line. So what we're talking about is allocating a portion of that free cash flow to a buyback. So it doesn't take away from investing in energy, for example.
Can I respond to
that,
Alex?
Yeah.
Can I? So a couple points. One, I just want to extend what I guess somebody said before. If they were needing $12 billion a year in capex, I would drop the buyback as well, but they're not. They're basically letting it build up in cash because the ROI on capex is going to be at least what it is if you're buying back stock at a share. Second, long term versus short term, it's dilutive to actually be buying back stock today. If you're looking at, you just look at the PE ratio for next year, flip that on its, which is 55 times. That means buying back stock, you're getting a 2% return versus you're giving up 4.5% interest. So from a short-term standpoint, it actually dilutes earnings per share by buying back stock. But it's long-term that you're doing this for because you believe that earnings are going to grow at, let's call it 30% a year over the next 5 years. Third point is everybody always says there's uncertainty. You know, my kids will say that, you know, I had it so easy and they have it so hard. We always look at the economic environment. There's always going to be uncertainty. So to say that this is the most uncertain it's ever been, I can recall 2009 when the global financial crisis hit. That was a lot more uncertain than today. And then fourth, if we wait until we're more diversified, to your point, Alexandra, the stock's going to be 400. Okay, so you want to be buying back stock at the most uncertainty. And if you get into some sort of financial trouble because the economy, you know, starts falling at 2 to 3%, you shut off the buyback. Buybacks aren't like dividends. You can shut them down at any time. And so what I like about buybacks is they send a signal to the market that they're deploying capital correctly and that there's no better use of the cash. And they can, you know, to your point, if you had, and I think the number before, I don't know who said it, but it was 23 billion of cash. There's 50 billion of free cash flow over the next 5 years. That's $70 billion that you got to put to work, or it's just going to grow in cash at 4% a year. That's a horrible use of yeah.
Gary, I have a question for you.
Sure.
What do you think the capital investment will be in 20 million robocars, robotaxis?
I don't know. I don't know what the number is, but
right. Well, I have another.
Saying,
okay.
I'm
asking. I want to ask the questions first. Then we'll argue. Let's not make an argument out of each answer. Let's just answer the questions. First question is the cost of 20 million robotaxis. Second question, what would the cost be of several 100,000 bots, of 7 robots that they would lease out? What do you think the investment would be?
I don't know. But it would buybacks are after that. That's the point where you miss this all the time because you don't cannibalize organic product. If you have 20 million robotaxis or 10 million bots to build, that comes before buybacks. They should do that. But that's not what they're saying in the 10K. They're saying 7 to 9 billion for the next 2 years. And I'm just taking it 2 years at a time. And you talk about free cash flow as it comes up. But if you had that type of capital expenditure need, neither one of us would be advocating buybacks. We wouldn't do it.
Look beyond the 2-year horizon. Let me just finish the point. Let's look beyond the 2-year horizon. The other thing that you're not looking at is the strategic environment. You say this is not the worst environment you've ever seen. You say 2008 is worse. I will tell you that this is far more serious than 2000.
And you must have lived different in 2008 than I did when Citibank was adopted.
Believe me, I had 2 companies in operation in 2008.
Larry, we have 2 to 3% GDP growth. 2008, 2009, we were declining GDP. Come on, you're not being realistic now.
I'm being very realistic. The current deficit in the United States is reaching a point that has not been seen in history. Not even right after the War of Independence. So, you know, you have a view, I have a view, but most importantly, Elon has a view. He is very sensitive to the economic environment, extremely sensitive to the economic environment, hypersensitive because he lived through 2000 and he lived through 2008. And by the way, his father lived through the Great Depression. So, you know, everybody has a different perspective. What counts is Elon's perspective.
Numbers are different, and you're talking concepts, and I'm talking numbers. 23 billion of cash plus 50 billion of free cash flow. If they have to spend 12 billion a year in capex, I would take buybacks right off the table. But that's not what they're telling people. They're telling people
But
7 to
Gary,
9.
Gary, you're mixing a couple of numbers, and let's just get a couple of facts straight. You called initially for a buyback in June 2022. Then the stock was about a 280, right? You called it again during the second half. Of course, it went down to $100, but imagine 1 second they would have followed you at 280, and then we had the stock at 100.
You don't do it all at once. You do it over
I
3
understand
or
it's a
4 or
program,
5
but it's a
years.
program over a couple of, not even years. I mean, if it's a program of 10 billion over a couple of years, we're
3 to
talking
5 years.
peanuts. Again,
3 to
I
5
tell
years.
you, they're issuing 10 million employee stocks per year. So if your whole thing is earnings per share because we are reducing the float, you're not reducing the float anyway because you're
It's
going
not
against the
earnings
earnings
per
per share.
share. You're mixing things. It's not about earnings per share. It's about internal rate of return, buying back stock versus ROI on cash. That's the way you should be thinking about it. And an IRA
Okay.
stock price is 12.5%. Back in January, it was 22%. It was huge.
Okay,
So
I understand it. So
earnings per
doing
share, that's not the goal.
No, I listen to you, but please listen to me as well. So I think companies are buying back shares because they're in effect admitting that they cannot invest their spare cash effectively in something else. So yes, at the moment they're at the moment in money market funds or short-term treasuries at 5%. It is what it is. But I do believe they know darn well that they can invest that money much better than into buying back the stock because by investing it, and I hear you saying, oh, it's going to be only 7 to 9. You are actually bringing together three numbers that, in my view, shouldn't be put together. You're saying they're building up 70 billion of cash over the next couple of years. Okay, so we have a point somewhere out there at 70 billion. Then you say capex is only 7 to 9 in the next 2 years, and then you say I'm on share buybacks now. So those are three different points in time. Let's wait for those 70 billion to do those share buybacks. You can't just anticipate that maybe at one point we may have 70 billion, and I know the capex in the next 2 years to do an action now. It doesn't work like that.
But if you're forecasting earnings per share, and I'm forecasting earnings per share that are much lower than you're going to have at least 70 billion of cash in 5 years. And if you wait till then, the stock's going to be at 600 a share. It's not going to be at 260 a share. There's a point where, why would you want to buy the stock back at $600 a share? I don't understand.
I'll give you an answer for that, Gary. Let's assume that in my mind, I'm running Tesla, and in my mind, several of my competitors are going to go insolvent or go to the wall in the next 5 years. Think about the opportunity and the challenge at that point, and think about what's going to happen, A, to auto shares, and B, what's going to happen, what's going to be the opportunity financially. And if I'm in the auto industry today and I face that situation, I would want to have the largest war chest on earth. Look, JP Morgan Chase didn't get where they are today because they figured out on financial the best way to optimize their share value. What they did was optimize their fortress balance sheet. They built a fortress balance sheet in 2002. They did not do what the financial analysts told them to do, which is buy all those mortgages. They simply spurned those mortgages. They built a fortress balance sheet. And when everybody else went to the wall, they came out in a magnificent firm. That's exactly what Elon's doing. He's building a fortress balance sheet. And if you can't see that, then, I can't convince you.
Yeah, but Larry, they have that fortress balance sheet now.
No, $20 billion is peanut. Man, it is peanuts. $20 billion is like,
you don't look at the raw number. It's not just the raw number, it's relative to the size of your company.
No, right? It's relative to the size of your competition. It's relative to the size of the market. You're looking at the wrong thing.
Right, but the competition doesn't produce profits like Tesla does.
No, but the competition has
money.
$50 to $100 billion of assets employed.
There is no competition. There is no competition.
They have 70 billion of cash because that's what they're going to have within 5 years. Do you think
that's what they need? That's what they're going to need.
For what? What do you want to spend 70 billion on? They're not even spending it now. They don't know what to do with it.
What is the TAM of the auto market?
Then you add the TAM of the bot market. Then you add the
you're going to buy up your competitors? Is that what you're saying?
No, I'm not going to buy up the competitors. I'm going to have to supply the full TAM of. I'm going to have to supply I don't know, 20 million cars, 100 million robo-taxis. I don't even know what's in Elon's head, but I do know this. It's massive. It's gigantic. And he is building a war chest. And nobody gets it.
And they're self-funding the entire way, Larry. That's what we're saying.
Yeah,
we don't want to take that away. We're talking about free cash flow, which is the bottom line.
For your free cash flow calculation, you take their 7 to 9, what they're putting in the K10 for the next 2 years. You don't see beyond that. But beyond that, it's not as if in 2 years everything stops. You can't just assume that is it. And that was written at a moment where the bot wasn't, was still looking for parts and whatever. They could have changed this week. And even if it was only 7 to 9, again, you're all projecting that the cash is just accumulating. We just don't know. Why would you spend good cash now for some assumption that maybe the free cash flow in 5 years is going to be 70 billion? We all hope so. Of course we do. But why would you throw out on top of it really for a tiny sugar high? I just proved to you that the float is not going to decrease a lot just because of a 10 billion share buyback. And that's the most they could do. So from 22 billion, they would give half away. Sure, not in one go over a certain period, but it would still be gone.
Okay, so Alexandra, first I got to correct you because we're assuming 12 billion in capex for next year, 14 the following year, 16 the following year after that, 18 the following year after that, and 20 the following year after that. You always say that my numbers are too conservative. I have net income growing from 16 billion next year to 24 billion, and this is my conservative numbers, 24 billion to by 2030 $1 billion a year. So that's what's causing my free cash flow to explode. And all that Meyer and I are saying is, if you're just going to put it into cash, why don't you give it back to the shareholders and let them do with it what they want? Why would you hoard it as cash just because you're afraid of the rainy day? That just makes no sense to anybody. I mean, nobody does that.
You're not afraid of it. You're not afraid to get of the rainy day.
Of course,
you want to take advantage. You want to take advantage of the rainy day. In the rainy day, it's not the cash that you may need to run your business. It's the cash that you may need to run many other businesses. I mean,
I'm just saying, build that in. If that's what they need it for, if they needed to buy a robo-taxi fleet or create 10,000 bots or however 10 million bots, go do it. But Meyer and I are both very much in favor of spending on an internal projects rather than buying back stock. What we don't like is seeing the cash build up at 4 to 5% because that's a waste of shareholder capital. It just is.
Actually, what you're saying is you don't trust Elon to capitalize on that cash as much as you can in your own pocket. And my own feeling is that Elon can capitalize on that cash far better than I can. Now I'm getting old, so that's one thing. But for the younger folk today, I mean, based on Elon's track record, I'd far rather invest the cash in him than invest the cash in me. That's my view.
And so would I, if he can come up with capital projects. And all Meyer and I are saying is let the board make an authorization. And if they can't figure out what to do with the cash, at least they can buy back stock because they have the authorization. If they can find things, to your point, that generate 25 to 30% ROIs, then do it. I'd be very happy if they were spending 12 billion, 14 billion. My problem is it doesn't seem to be that they have enough capital projects to spend all the cash because they're letting it build at 4 to 5% per year, which is a waste.
And just to put it into context, the size of the net cash position at this point for Tesla ranks number 1 among big tech. If you look at it from net cash to OPEX, so that's total cash on the balance sheet minus total debt, both short-term and long-term, divided by annual operating expenses. Tesla ranks number 1.
We know that. I do my tables all the time, but that is because there is no debt.
I just want to say, I love you guys. Thank you for having me up. It's a freaking honor. Sawyer, Alex, all you guys, Selena, all you guys, Gary. I just want to say I leave it up to Elon. I totally feel what Larry's saying. I trust him more than I trust the shareholders, honestly.
Yeah, I think that's what we're saying. But I really think that if you look at the actual dollars that they're investing. The capex has increased year over year quite significantly, and the capex forecast has increased quite significantly year over year. But yeah, anyway.
And they're still producing positive free cash flow despite that, right?
Well,
so
but that shows very good stewardship. But we don't have a very clear vision of where they're going. We have some outlines. We know there's a robo-taxi fleet coming. We know there are bots coming. I think that the reality is that the people who believe in the share buybacks don't believe in the robo-taxi fleet and don't believe in the fleet of bots coming. And I think those that see those fleets coming understand the need for capex for much greater amounts of capex.
Generalizing, Larry, that is not true. And I think what we're doing is the math. And the math says if you're going to spend money on cash, and even if you can grossly inflate it from where it is today, even if you do that, you still have this cash left over because the company is so profitable. And the question is, what do you do with all that cash? If they can come up with robo-taxis and bots and others, who knows what other business they can get into. We all trust Elon or we wouldn't be invested in the stock. I always tell people that. They say, well, you don't trust Elon. You think you can run the business better? No, I don't. I wouldn't be invested in him if I thought that. All right. I believe in him, but I'm just saying there should be some outlet for the cash if they can't figure out to do with it rather than put a cash at 45. That's all I'm saying. And if they can come up with
Gary, so just one question because it's today. So why did you sell yesterday if you so believe in Elon?
Because when we're looking at upside, downside, and this is a different discussion of what we're having, we just thought that Rivian has more upside, downside than Tesla. So we put more money into Rivian, took some money out of Tesla, because I don't, and I said this on your last Tesla call, I don't have 100% conviction that Elon's not going to cut prices further in the fourth quarter if the current price cuts don't work, which they probably won't, because he's cutting $2,000 out of Model Y and $1,250 out of Model 3. So if he cuts prices again, the stock's going to go down again. And so when I think about upside downside, I don't worry about Rivian doing that. So that's the simple answer.
I still don't understand why is everyone so focused on the cutting of prices. I mean, I just don't get it. They're so profitable. Like, it controls the price action. I mean, I don't know. Somebody can clear this up for me.
Because the margins are down 50%, 50 year over. That's a big number. And if you keep, look, the number one thing that drives, look, we're in this as investors, all right? At least I am. And I could put my money into anything. I could put it into Google. I could put it into Rivian. I could put it into Lucid if I wanted to. And I'm looking for the highest upside versus downside. And if you're going to keep cutting price and there's no elasticity of demand, meaning you're not seeing incremental volume growth as a result of the cutting of the price, why would I keep putting incremental dollars into that investment? Because you're going to lose cash flow. Your cash flow is going to start going down.
Guys, we've got a couple of hands up there we haven't paid attention to. Bradford's got his hands up and JP's got his hands up. So I think we need to let these guys talk.
I just want to make a brief point about robotaxi and the need for cash. I think when the time comes, let's say Tesla wants to keep some robotaxis to themselves. Essentially what they could do is they can decide to do a percentage of cars to keep in-house and a percentage of cars to sell to the public. And that way they can essentially pay for the ones where they're keeping in-house. And I expect this to come regardless of whether there's a buyback or not. I would expect, like, if they solve autonomy, there should be a huge increase in production, and they would need to take a mixed approach to it.
Yeah, and a quick point on again, how miraculous, I almost want to use that word, at how miraculous the fact that positive free cash flow right now, despite relentless price cuts, which has put a lot of margin pressure this year, everyone knows that. At the same time, the capex to depreciation ratio, which tells you how much they're aggressively investing in capex, right, for growth capex. This is now at cycle highs. It's almost 2 times, meaning their capex is outpacing depreciation by 2 to 1. That means that's an aggressive growth investment phase that they're going through. That comes at a high cost with new depreciation expense going through. So despite 2 headwinds simultaneously, price cuts, which put margin pressure, and increased growth capex, which also puts margin pressure, there's still positive free cash flow. So it's actually, it's amazing
less than $1 billion, of less than 500 million in Q1. I mean, I'm all for it, and but you're making it sound as we're swimming there. We're not.
Well, it was 400. It was like, okay, let's just say it was 500 million in Q1. It was $1 billion in Q2. And it's probably going to be $1.5 billion in Q3. We'll find out. But the point is that we're coming at this from a position of incredible balance sheet strength, right? They've paid down debt. They now have net cash, 20 billion, 21 billion.
Yes, mid-2022, yes. October 2023, thank heavens there is no debt anymore. It's not as good anymore. It's great. They're doing great in the current environment, but we're certainly not in an environment where we should even think about share buyback. I just wonder why this subject even came back up.
Because they have so they rank number one by net cash to operating expenses. Number one, CapEx plus operating expenses.
You're comparing them to software companies for the most part.
That's an even harder comp, though.
It's not even close. When you sign a SaaS contract, they have no inventory, the production's faster, it's basically on-demand cycles, there's no lead times. You can't compare it to a regular tech company at all. It's completely different.
Well, in big tech, we have NVIDIA, we have Apple.
They're on-demand. They have on-demand inventory. There's no lag. Tesla's like a 6-month material lag between what they're sourcing and then when they get to final production.
Exactly.
Like
so that's even so, their free cash flow comes under more pressure because of what you just said.
I understand.
That's the point.
That's why you can't use your cash and just buy back stock when you have variability in global dynamics. What happens if World War III just started today, over this weekend? Then what?
I would argue we're already there.
Exactly. So my point is, and if I could, I think, to be fair, I agree with what everyone has said. Everyone is technically correct in their approach. The question is, when is the right time to do it? And I just want to point out one other thing. Robotaxi, bots, whatever, those are in the future. If you look at Tesla's balance sheet, it's up 300% from 2020 to now. The operating cash flow that they need for their assets to produce and maintain both vehicles and energy hardware is up 100%. They need more operating cash flow. It's not just showing up in CapEx, but we're going to see more megapack factories. I personally think free cash flow is going to explode at a much higher rate in the relatively near future as the energy business proliferates, because the services to energy are exponential relative to the auto. My feeling is that Tesla would actually be better off issuing a dividend once that business gets to slight maturity, and then potentially doing a buyback at some point. But I think we're missing kind of the trees through the forest, that we're sitting on 20 billion of an $850 billion market cap company, which is nothing. And therefore, if we wait a little bit longer and we start to see the operating revenue, which both Zach and Elon and everyone talked about coming from the energy business, and that we should be looking at operating revenue and operating free cash flow. Once the energy business matures, the numbers will spike. At that point, people will recognize Tesla not as an auto company, but as a multi-service energy company that also sells cars. And it will also, right now, I also think that if Tesla did a buyback, all the bears in this macro environment would say Tesla will have to do a debt or equity raise if margins go down at all in the next 2 months or next 2 quarters or whatnot. So I agree that we could do one. I think it weakens Tesla's overall market position. But I think in a year from now or 18 months from now, there's an opportunity to potentially do a buyback and a dividend issuance at the same time or consecutively. But I think right now, where we're sitting from a geopolitical, macro, and also business upcycle, I think you're better off earning the 4.5% in T-bills and having a little bit of cash to optimize your situation right now.
But JP, then you're buying high, right? Why wouldn't you buy the stock when it's cheap? Because if you bought it back a year from now and the stock's at 400, your IRR is going to be like 5%. It wouldn't make any sense.
I don't think they're going to do a buyback.
I wouldn't be buying back stock at $400.
Correct. I think Tesla will be the biggest dividend company in the world when it's fully mature. I don't think buying the stock means anything. Right now, sitting on the cash prevents anyone from shorting it because they can do the buyback. If you really want to give money back to shareholders, if the EPS is going to be $20 a share, what could the dividend be?
I don't know. I buy low and sell high. I don't do the opposite, so I can't even.
Yeah, but Tesla is not a trade.
That's not my question.
I buy low and sell high when I know what the price now is and I know what the price in the future is going to be. And I think everybody's making so many assumptions And the one assumption that they can't make is what is in the mind of the company. And what's in the mind of the company is pretty clear. By the way, there was a huge share buyback this quarter, $736 million of stock and cash that the board is giving back to the company. So I haven't seen it do anything much to the stock price.
Larry, where do you think the stock will trade in 5 years? That's the fundamental question. That's what you.
That is exactly the right question.
It is not the fundamental question. The question is, what do I think Elon is going to do to make the stock be worth much more in a few years' time? You guys are all. Do you know the story of Get Out of My Car? Do you know the story Get Out of My Car?
No, but you didn't answer my question.
No, I'm asking the question now. The story of Get Out of My Car is this whole family are all imagining what this new car that they're going to get is going to look like. And then, you know, the youngest kid says, look, you all get out of my car. I mean, you're all imagining some future. You're all projecting some future. And you're determining the company's strategy with its most valuable asset, single most valuable asset. And you have no idea what the company's plan is for that asset. It's crazy. Either you have confidence in the management, which apparently, Gary, you do not.
I do. Don't make stuff up, Larry. That is not
true.
But
you're selling the stock because their pricing policies are wrong.
It's our number 2 position. It's upside down.
I don't think it's a lack of confidence in Elon. I think
bullshit.
Elon is like perpetually in like bunker mode, survival mode, and it's like he's trained his AI to kind of be in that mode.
But it's a bloody good mode to be in current. I'm in that mode myself at this point. And those guys who are not in that mode are crazy.
Okay. I just want to point out we have total confidence in Elon Musk and Tesla, or it wouldn't be our number 2 position. We're constantly looking at upside, downside, to size position. It is our number 2 position. Second, when you're thinking about a buyback, you got to be thinking about the IRR compared to the alternative, which is building cash. And if the IRR today is 12%, because we're assuming in 5 years the stock will be 660. If you think the stock's going to be 1,000, the IRR is even higher, right? And that's why I tried to get Larry to come to say, what is the number that he thinks the stock's going to be at in 5 years? Because that's the fundamental question. When you sit in the corporate treasury department, I've worked in corporate treasury, okay? That's what people do. They try to figure out what is the IRR of different financial investments, of an M&A transaction, of buying down debt, or building cash, or buying back stock. That's all you do. And so if you don't want to think like that, you're not thinking the way a corporate treasurer thinks.
I'm not a corporate treasurer, and I thank God I'm not a corporate treasurer, because those guys only get into trouble. My own experience is that whatever you think is going to happen in the future, it's not. And as an owner and a manager and an operator of a company, I have to think of risk first. And I think that Elon is thinking of this now. Brad says that he's in a bunker mentality. I think that's an extremely good mentality to be in today. If you're not in that mentality today, you probably won't be around in 5 years' time. That was the mentality of JP Morgan Chase in 2000. And look where it got them. That's all I have to say. I mean, I don't know how many ways I can say it.
Thank you, Larry. I appreciate that. Let's also give the scene to Aptera and then to Ryan, please.
Yeah, I think that one of the things that Gary Black said earlier, was how Tesla, if they did a buyback, if the board said it was okay to do a buyback, that they would do this over a several-year period. I think that assumption is incorrect. I think we're talking about Tesla. I think we have to throw those assumptions about how other companies do buybacks out the window. I think that Elon in particular, based on what they did with Bitcoin and things like that, they don't do it like how other companies do it. So I would imagine that there's a good chance that they would actually, when they're ready to a buyback, when they feel that they're positioned well to do it, they'll announce it, and probably within a quarter or two, they'll probably try to complete that buyback rather than spread it over multiple years. Because I think that gives them the ability to get the gains on what that buyback is much quicker than the traditional company that's doing it.
Thanks, Aptera. Ryan, unmute yourself, please.
Hey, what's going on? Can everyone hear me? Perfect. Yeah, great discussion so far. Some of the things that I want to comment on, I just shared in in the chat. So from a consumer perspective, I think price really matters considerably. And when we start to think about like the dominant hardware and software network that Tesla can turn into, similar to Apple, the name of the game there is really having as many users on the platform as possible and then building ancillary services around that, like the App Store or like full self-driving, and just continuously improve that product to keep folks in. So the point there in regards to buybacks is I think we should hold on to that cash in order to kind of weather the margin pressure that we're going to have. That's point number one. And then when I look to build off more on the Apple analog, I think this chart tells a very compelling story that in 2013, when Apple started to buy back the stock, they had 3.5 times higher net income and 4 times higher free cash flow in non-inflation adjusted figures. So if we're comparing balance sheets towards the most relevant historical comparison, I think we're nowhere close to the balance sheet strength that Apple had. And Steve Jobs thought long and hard about whether buybacks were in the best interest of Apple. He even said it means that we've run out of like internal ideas to invest in. It wasn't until he sat down with Warren Buffett where he kind of found that he found the justification for share buybacks. And then last point here, and then I'll comment on one of the things that have been discussed. There's better uses of funds all over the place. And instead of thinking like, hey, we spent all our money, but we have money left over, I think the question should be, we spent all our money, let's look to spend more money instead of operating under this limit that there's like a threshold of dollars that can be spent. If you look at the Tesla Google search trends and overlay that onto a number of superchargers by state, I think there's a very compelling correlation there, both visually and mathematically, that people who see the Tesla infrastructure out in public are going to kind of we're going to, kill two birds with one stone there. It's public permanent advertising, similar to like a billboard. Plus, it also helps solve the range anxiety problem, because I think the two biggest elements to like accelerating customer adoption is price, which I talked about, and range anxiety. Yeah, why don't I go ahead and wrap it up there? I think I got all my main points in. Thanks for letting me
and thanks for preparing the charts. Jean-Paul?
Gary, the question I had, you mentioned that you're at $90 billion in net income. What year do you have that happening?
2030.
Okay. What if the $20 billion accelerates that to like 2026?
Then that's even more of a reason to do the buyback, because the stock's going to be worth more. It's always about, what is it worth today? Buy low, and that's the only decision you have to make. Once you've got all your capital needs satisfied, if they want to build a lot more superchargers, great. The ROI is very high. You want to build bots? Great. The ROI is high. I'm just worried about them taking all the cash after all the capital needs internally and putting it into cash at 4 to 5%. And, to Alexandra's point, she's right. You don't, from an accounting standpoint, it doesn't get you much of a sugar high. It's really a long-term, from a principal standpoint, you're basically buying today when the stock's at 260 because you think it's going to be 660 or more. We think 660 or more by 2030. If you think it's going to get to 20 billion by 2026, stock will be 660 by 2026. The IRR is even higher. And that's
I understand where you're coming from, and I agree. I'm not arguing with it. My question is, your core principle in this scenario, though, is about returning value to shareholders, right? Returning.
No, it's about not wasting cash at 4 to 5% because you think
I agree.
The world's going to end.
But my question is that I'm wondering, is it 6 dozen half the other, right? Like, so if the 20 billion accelerates the net income earlier, right, by mega pack factories, etc., and then in 2026 they can, if you have 100 billion, 90 to 100 billion in net income, they could use 50% of that and issue it a dividend. That's $14, $15 per share. You can probably just maybe 13 after you use the issuance for employees, but like, that's a very large dividend for a growth company with a good balance sheet. And you're only using 50% of your net income, essentially, to fund that? Like,
Look,
do you like? I guess my question is like, we're making it seem like buybacks are the only way to return equity shareholder value. Like, the stock going up and receiving a dividend off of free cash flow businesses is generally a very good principle and something that attracts equity investment too. Like, are you opposed to like that thought process?
Yes, because the dividends lock you in. Once you put a dividend out there, it's, in my experience, it's very hard to reduce it. With a buyback, if World War III starts or the economy is a lot worse, you can always end the buyback. It's very opportunistic. Dividend, you're locked and loaded. You can't really change it. I mean, you could, but it just doesn't happen in practice.
I guess my question is, if it's baked into this energy business, which is not, it's more secular and less discretionary than the auto business, right? And people realize that, like, you know, if Tesla really becomes an energy company, which is the mission of the company, I think I agree, it does lock you in, but like, it's also going to be less of a risk because it's very similar to what other companies in those businesses do.
All I'm saying is, if you put $10 into dividends versus $10 of buybacks, most investors like me would choose $10 of buybacks because it gives you flexibility to end them if the world ends tomorrow. And that's the only thing that, you know, I'm trying to point out, that you're locking yourself into something very rigid once you put a dividend structure in place. Buybacks can be very opportunistic, and so that's it.
Significantly more advantageous than dividends.
Yes,
I mean, in general terms. Yeah, in general terms.
No, I agree. I just was thinking of another way to return equity shareholder value that also is defensive. And, you know, I think there's probably going to be a time where Tesla does both a buyback and does issue a dividend, because the CapEx is going to go down at some point drastically. And there's going to be free cash flow from services, whether it's auto related or energy related, that they're going to have, you know, there's not going to be much for them to do with it. So they're going to have to give it back, or, you know, or keep buying back shares. So I'm just thinking of multiple ways where equity is returned to shareholders.
That's fine, JP. I just don't think that's the debate on the table. The debate on the table seems to be, do you let it build up in cash so you can have money for the rainy day that may come, or do you give it back to the shareholders in some form? And whether it be dividends or buybacks, you're giving back. I prefer buybacks, as Larry just said. The tax rate's lower, and the way I look at it is not as rigid. But I don't think that's the debate. The debate is you let the cash buyback build up for the rainy day to make sure that, you know, you have it, or you want to, you know, exploit the opportunity down the road, or do you give it back to shareholders? And all I'm saying is, give some of it back to shareholders. You don't give it all back, but you give some back.
Yeah, I just want to comment on the whole Apple comparison. I think Apple bought back too late. Like, they started too late. It got all the way down to like an 11 PE at one point in time. That's when like Carl Icahn got involved. And Tesla needs to not wait to get to that point. The other piece is, like, Apple's business didn't accelerate since then. Apple's business, I think since 2011 or so, you know, roughly since Steve Jobs died, has only grown, I don't know if it's top line or bottom line, like 11% a year. The main reason why the stock has done so well has been the buyback. A lot of us are Tesla bulls, and we wouldn't be invested in Tesla if we think Tesla is only going to grow by the cost of capital. Now, you know, cost of capital, Gary, what is it, 14, 15% for Tesla now?
Cost of equity is that, yeah. Cost of debt's like 4, you know.
Yeah, so like basically, you know, investing in Tesla, we think that it's going to grow at least 15% on average. So like, you know, 15% versus looking at the cash. I also respect what you all are saying with price cuts, but if you told me last year that they would have cut the prices all the way to where they are today, I wouldn't think they're still cash flow positive, you know, without doing the math, you know. I would be shocked that they'd be cash flow positive, but they are. So this has given me a lot to think about. I really appreciate the debate, Meyer.
Yeah, and here's another example. You know, NVIDIA. NVIDIA is a hyper-growth company like Tesla is right now. They've got an order backlog that extends way out, and they're buying back stock, right? You think NVIDIA doesn't have investment growth opportunities? You think NVIDIA doesn't want to, you know, prepare for global recession or other emergencies that come up? You know, NVIDIA is phenomenal.
NVIDIA is a commodity. They're basically buying back stock while it's opportunistic. The technology becomes commoditized, and they don't have any secret sauce. Like their GPU rates didn't even go up on their own accord. They hired a consulting firm that actually first broke them out into like the AI rate, and then they kind of broke through. But like, it's going to be similar to Apple. Like, there's only X amount of gaming systems that you can sell. There's X amount of cars, and if you look at the actual, whether it's the end user applications, most of the big companies, like the other big tech, are building their specific chips for their software. So Google, Microsoft, Apple, Tesla, they brought the most high-end chips they need are being built in-house, with their own specs direct from the factories. NVIDIA is it's probably the most overvalued stock right now in the world. But like, we don't even go down that road, but like, it's just not a really great comp. But like, they're opportunistically buying shares and adding equity value while they can, which is what Gary's point is right now. But I think Larry and Alexandra are right to point out, like, it's a little bit more murky in a larger scale manufacturing business that is majority based on discretionary purchases of autos, which is cyclical, and the macro in this current environment is not super conducive to erasing some of your cash cushion if it gets worse. But I will say, to Brad's point, which I think we have all, maybe not we all, but like a lot of people have kind of looked at Tesla pricing from, say, 2021. The company just started there, and not where the prices for the vehicles were prior, especially the 3 and the Y. The prices today are closer to the launch prices and the Model 3 was always billed as going to be a $35,000 car or less from day one. And Tesla was actually getting shit for it being so expensive and not being $35,000. The Model Y launched at $40,000 for the rear wheel, I think, and $49,000 for the all-wheel drive version. The prices today are roughly right around those launch prices. The only thing that's actually changed, which no one spends enough time talking about, is that the investment in the production capacity and the delivery of these cars has gone down drastically for Tesla. By being regional production, building those factories costs money and hurt margins, even though the price went up and the margins were better. Tesla's getting to a normal CapEx, normal operating model by having 4 plants regionally producing and delivering vehicles. Additionally, the patent expiration on batteries has enabled costs to go down drastically, which is why lithium prices have all fallen during the peak, versus the peak of COVID. We're going to see what the actual margins per vehicle are in the next, 2 to 6 quarters based on the improved efficiencies. But I am fairly certain the cost to produce a vehicle today versus any time during COVID or 2019 is definitely cheaper than, 2023 cost to produce unit vehicle versus is significantly lower.
Which augurs toward buyback. JP, I would say like the opposite of a commodity is where people are forced to buy your product. Tesla, Twitter, Meta, Amazon, XA, all forced to buy from NVIDIA. It's definitely not a commodity. And when we look at Tesla, it's the same way. Tesla makes very compelling products. They are not selling commodity. They are needing to lower price a bit, but it is not a commodity either. But I know you weren't making that point with Tesla, but I wanted to share that for other people.
Yeah, and I'm actually going to have to wrap up here soon here, but I think at the end of the day, all we're really asking for is to be discretionary, right? It's not that we have to, I don't think anybody here, definitely not myself, and I'm guessing not Gary or anyone else either, nobody wants to take $10 billion and just throw it all into Tesla stock today, right? That's not what we're saying. Buybacks are discretionary in nature. Now, some companies do a consistent buyback at any price. They just allocate a set dollar amount every quarter or every year, and they just do it at any price. I'm not even advocating for that. I'm just saying that, have the board authorize a buyback, make it a big number like 5 billion or 10 billion, whatever it is. But, that number gets allocated steadily over a decade, and that's really how companies add value over the long run. As of right now.
Meyer, let me maybe just make a point. Why did we get to this debate? We got to this debate because I think on Sunday or Monday, you said the Tesla fan community, I don't remember the disparaging word, but it wasn't a nice word, didn't get what buybacks was all about. It was, after all, capex, and we were too stupid to understand, and it's about time we woke up. That's why I reacted, and I said, next you call us deplorables, and let's do a space and debate this. So if we're going back to that point, I just would like to make the point again. I think we all very well understand what share buybacks are, and we're not too stupid to understand that this is after capital expenditure. So if those arguments come up again and again, I will call for spaces again and again. And at the end of the space, you will all say, oh, I didn't call for 10 billion. Oh, I didn't call for right now, because maybe we understood and maybe you understood less.
Every time I talk about buybacks, everybody always replied that the comments are filled with people that says, no, they need to invest in more factories. We have 4680, we've got the Optimus, we've got FSD. Well, see, this is why I made that comment. I wasn't referring to you, by the way. I never actually mentioned your name at all. I'm just saying that my comments are always filled by people that say, well, what about this program and that program and this? The point about buybacks is that they're never to interfere with the core business. Right? Buybacks are probably the last or second to last item that a company can do with its free cash flow. Right? So after all growth expenditures are exhausted, the company still has positive cash flow. And if the balance sheet
we're not even close to that yet. So that's what we're trying to say.
If the balance sheet is de-risked, right, at the level that it is right now, remember, again, I keep saying this over and over, Tesla ranks #1 among big tech by net cash to operating expenses. They have almost 3 years of cash right now. So if revenue goes to zero, right, they can survive 3 years.
You keep comparing this to big tech. Tesla is a manufacturer first and foremost. Big tech is not a manufacturer. You're confusing apples and oranges. You cannot compare an auto manufacturing company of all companies to big tech. You just can't. Whether you say
Larry, if it's better than an asset-light company and you're a manufacturer, it's an even better comparison.
The rate at which Tesla's cash flow is shrinking quarter over quarter, this is the last time to think about talking about dispersing that.
Anyway, I really appreciated that. I know, Mayor, you want to cut it off, and I think we've had it. We've turned around it in circles. I really appreciate that you took this on, because given how hostile this was when we started the tweet exchange, it was great to talk about it. I think we all brought forward our points. I'm really glad this happened, and I hope we're doing others on other subjects soon.
Thank you for having me up, Alex. I'm a small fish. Thank you
for bringing me up. Yep. I just want to say 100% correct. You're 100% correct in your analysis on how buybacks operate and whether they should be done. I think if the number was 50 billion plus, everyone would be, for it. I think everyone's just a little bit more skittish, because I think if Tesla's actual cash dropped lower than it currently is, the actual market sentiment might change towards it. And there's not really a defense for Tesla, other than hoping the macro gets better. And hope's not really a plan. But I think you're 100% correct under normal conditions. I just don't think for an $850 billion company, $20 billion or $10 billion, or that's what we're saying, is not really enough to move the needle currently.
Okie doke. Let's leave it at that. Thanks a lot. Bye-bye.
Thanks, everyone.